Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins-Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And with us today, we have a special guest, Matt Faircloth. Matt, welcome.
What's happening, Whitney? How are you today?
Doing great. We were just chatting a little bit before the show.
Yeah.
I want to make sure we leave plenty of time to talk about your deal today. But before we dive into those details around the Rosa Capital 15 fund that had 670 units, which was 5 apartment buildings across the state?
5 apartment buildings in 2 states. Yeah, about as complex as they get.
I can't wait to dive into the details today. But tell us a little bit about yourself, how you got into multifamily investing and where you're at today.
So, Matt Faircloth, reside in Pennsylvania, just north of Philadelphia with my lovely wife, Liz, 2 kids, and now a new dog, new family member, Bailey, our dog. And I'm a full-time multifamily investor. I have been so for the last 6 years, but I've also been a full-time real estate investor in general for the last 17 years, believe it or not, Whitney. So the way I got heavy into multifamily was we were used to do small deals, like 5 units here, 10 units here, 4 units there, kind of thing. And I did a lot of it through raising capital. And we started raising more and more money to the point where we had the resources, capital, and also the know-how that we had learned on the smaller deals to do much larger projects. And so we slowly scaled up. We did a 10 unit, then we did a 49 unit, and then we went from there and did a 200 unit. And then it was just, we realized how much easier the larger deals can be if you've got the wherewithal and the team, the capital raising capacity and asset management and balance sheet and all those things to take down larger projects. They can be a good place to scale. And so that's where we decided to scale out our business, is in mid-sized multifamily. And that's been since about 2016, I think, that we've just only focused on mid-sized multi.
Awesome. It sounds a lot like the stack method, like
Yes.
Turner, right?
Yes. Yeah. Double your portfolio every time you do a deal.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy day cash reserve with a high yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
Let's dive into the details. Okay, so the deal we're talking about today is DeRosa Capital 15. So it's actually a portfolio of properties, 5 buildings, 670 total units, and across 2 states. What 2 states?
Kentucky and North Carolina. Before we go further, I should also say that we called it DeRosa Capital 15, just not because like 15 is my lucky number or something like that. It's called DeRosa Capital 15 because we number our syndications. That is our 15th investor aggregation of people to do work with us, our 15th project involving syndication of investors' capital into something. So super exciting to have that track record of investors to go along with us. So DeRosa Capital 15 consisted of 670 units in 2 states, 5 apartment buildings in Kentucky and North Carolina, both of which are markets that we already had presence.
Oh, fantastic. Well, so let's talk about, when did you close on this deal?
Well, for that kind of a size deal, Whitney, you don't just close on it. You kind of close over a period of time. It's like, when's closing going to happen? Well, let's see, what day is it? So it's closing happened, part of which in February and part of which in March of 2022.
Okay. So you don't have like a set closing day of like 3:59 p.m. on a Wednesday.
There was no champagne because it was like 4 closings. Would have been a lot of champagne.
Right? There's champagne at the end after the last closing. Right?
Yeah. I think we might have taken a nap after that. But yes, after the last closing, that was like the final, like, okay, we're done.
Awesome. Okay. So how did you find these properties?
We are primarily working with brokers on our deals. I know there's folks out there that are doing off the market stuff, and we've done a few off the market mid-size multi, but mid-size multifamily, Whitney, is not typically traded through wholesalers or a secondary off the market kind of thing. You get these brokers that have what they call off the market listings or pocket listings or whatever, but all that means is they don't have a full exclusive right to sell. Like they don't have a full agreement. They just have an owner's financials and an owner that says, well, I would sell if you could get me X in that. So there's pocket listings and that kind of stuff. So a lot of properties like that are, but these, all 5 were presented by real estate brokers that we already had relationships with. And I should also note they're in markets that we already own in, because DeRosa is very market centric. So we try and acquire at least 1,000 units in every market that we invest in, one of which is Lexington, Kentucky. We firmly believe in Lexington. We think it's a great market to invest in. It's got a phenomenal story as a market. And the other one is Winston-Salem. And we also own in Winston-Salem already. So both these markets were ones we already had property managers lined up in, already had in and everything like that. And we just wanted to scale and go that much further in those markets. And so when you focus, it's easy to grow because we say no to a lot of markets. There's only 2 markets in the US that we were saying yes to at the time.
These were on-market deals. And how did you structure the deals? And how did you line those up for closing? Like, what was the timeline to close? It was over 1 month, right? 4 weeks?
It was over about a 45-day period. Now, there were different sellers, right? So there was 3 different sellers involved in these transactions. One seller owned 2 apartment buildings in North Carolina. One seller owned 2 apartment buildings in Kentucky, and one seller owned 1 apartment building in Kentucky that happened to be right across the street from one of the other ones that we were buying. So it was a total of 4 closings, but one of those closings was with the same seller, just kind of staggered the timeline on those closings. And what was interesting is the way that it happened was the North Carolina deals show up first, and we win the bid. We put together a great business plan. We leveraged those properties with other ones that we have there in the city of Winston-Salem, leveraged our resources there, leveraged our team. We believe in Winston-Salem. And so we put together a good winning business plan and we won the bid, right? And so we go to contracts on that. And as we go to contracts on that one, we got a phone call from the broker in Kentucky that a deal that we were looking at months earlier had fallen out of contract. That buyer just got funky, tried to retrade, really didn't have the balance sheet that was required to qualify for the mortgage, just wasn't able to close due to issues they had on their side. Not because it was a bad deal, but because they were trying to get a better deal out of the seller. And it turned out they really weren't qualified to be buying that kind of deal anyway. And so that deal had fallen apart. And that was a deal we were very interested in, and we were second best. I cannot tell you, Whitney, how many times I have closed on deals that we were the second best during the bidding process. And it came back to us because the number 1 bidder wasn't able to get it to the table. And so while we're under contract, going to contract in North Carolina, we get a phone call saying, hey, those 2 in Kentucky that you really liked are now available. Well, are you guys interested? And we were actually able to get a little bit better price than our original offer was, which is negotiation 101, right? So we got a better number on those. And we said, well, what do we do? Do we run these 2 concurrently? Do we raise capital and close on one group of properties, the North Carolina group, and also the Kentucky group run a separate capital raise, a separate purchasing initiative, and by those kind of, if you will, Whitney, sell 2 flavors of ice cream when it comes to raising capital, right? And that's almost what we did. But I consulted with a few mentors of mine and folks that I highly respect that have done this type of purchase called a portfolio. And the way that works is it's not a fund, right? But you raise a pool of money that is allocated for all those purchases all at once for the purchase of a group of apartment buildings. And so it's clear what the money's going into. And it is clear what the business plan is going to look like and everything like that. It's not like a fund that just has a thesis or we're going to invest under these parameters. No, we're going to invest in these specific properties. Just so happens that they're geographically diverse. They're management company diverse. They're economic market diverse. So a lot of good things about these properties. And so this mentor of mine convinced me like, well, this is what you got to do is you have to close on them at the same time under one entity and take them all down at once. And he convinced me to do it. And so that was our business plan moving forward. And all that happened, say, November of 2021.
Okay. So you have these properties under contract in November 2021. You're getting into the due diligence process. Walk me through how you structured each of the purchase sale agreements. And what was your due diligence timeline? Was there any money that you had to put down hard on these? And then we're going to dive into, were there any surprises that came up in due diligence? Oh boy, man. I mean, it was like a surprise party. But for that many units, Whitney, for 670 units, I mean, you can't help but have surprises, right? So I'll unpack all that. What's interesting is that we go into due diligence and some folks that are sitting here doing math are saying, hey, Matt, there's only 4 buildings in conversation and you said 5 because we were approached about 2 properties in Kentucky and we were under contract already in 2 in North Carolina. So this is what happens. We go out there for due diligence and we notice that there is a smaller apartment building that's across the street from one of the ones that we're buying in Kentucky. And we're with the broker and we're like, hey, what's that right there across the street? It looks, almost the exact same brick finish and same physical structures, same vintage, same meaning built in the same year and everything like that as this. It's like, oh, that's owned by this local guy. And he lives here in town. He's owned it forever. I got his phone number. I'm like, well, why don't you give him a call and see if he'll do a deal? See if he'll sell us that. Of give or take around the same number we're buying this for. This property I'm standing on right now, will he sell that I could throw a rock at right now and manage under the same management office? And I said, oh, sure. So we were boots on the ground for 3 days, Whitney, while we were there walking, let's say, property A. And before we knew it, we were able to strike a verbal agreement for property B sitting right across the street. So that's how the 5th one gets added is while we're there, we just looked around a little bit. And so what could get added to juice this to make it a little more sweeter for our investors? And so we added that one property across the street, which is another 80 some units. That's how we got to 670 or 5 apartment buildings all in. Interesting, right? Really, the conversation away from due diligence, it also seems like a unique way to kind of eliminate the competition.
Yeah.
Right?
Well, no, it wasn't even the market. It was just the broker was like, oh yeah, I know that guy. Let me call him up. Right. Like,
now you're not competing with another building across the street. You own the other building across the street.
No, I want to own that. I don't want him cutting his rents. I want that too. I want that to be in harmony with what I have here. So if I'm going to be doing a marketing special or if I'm cleaning up the units to try and raise the area and have tenants that really care about their units and have nice amenities that I can share and stuff like that, I want to have all that under one roof. And it's just cheaper for us to do it because I can use my staff that I already have running this property to help me with the one across the street too. So it's just a way to scale easily. And so it's advice to anybody listening that if you're buying one apartment building, when your boots on the ground, look around a little bit and have the broker look around with you to say, well, what's that right there that I can see it? Like if I picked up a rock and threw it, it would hit that property. What is it? Tell me more about it. You never know. So that's how we get to 670. We go to contracts. Yes, we had a lot of money hard, non-refundable and earnest money deposits. It was roughly 1.2 million. Total purchase price was 57,500,000 on all these properties. And yeah, there was 1.2 earnest money. About half of that was non-refundable day one. That money came, a lot of it from us and my general partnership team, because we've done this a few times. We've got like a pool of cash that we can use for earnest money deposits. But we also had some of our investors that love what we do decide to invest early enough in the deal. And we had our lawyer draw up agreements and stuff like that they could sign that allowed some of our investor cash to go into the deal early enough that it was considered LP equity, but it came into the deal to the point where it could help us fund the earnest money deposit. So anybody listening, you want to do that too, talk to your lawyer. I am not a lawyer, but you can talk to your lawyer and they can have you do that.
Awesome. Okay. So now you have 5 properties under contract. What was your average due diligence timeline? You said it was a surprise party. Those are your words.
Oh, goodness.
What was the surprise? Did you walk every unit?
I did not do that myself, no. But the due diligence period was, I think on those properties, we typically do 30. People want to see 30, but we like to do is 30 with an option to extend just in case things come up. Okay, they sure did. So we were under contract for a 30-day due diligence with an option to extend for another 15 with additional money going across the table for earnest money. That's what we ended up moving forward with. The North Carolina properties were fairly straightforward, right? Not that Kentucky stuff wasn't well maintained, but the North Carolina stuff was extremely professionally managed, was in good shape all in. The owner had dissolved a lot of the deferred maintenance stuff, right? So there wasn't things that needed to happen as much. They had taken care of a lot of that. And they had also begun a business plan to renovate apartments. And they had shown, hey, we've done around 15% of the units. You guys can step in and do the other 85% on renovations. So it's very clearly well-defined business plans. They're pretty clean, like a layup, right? Very clean deal. And so that deal went right through due diligence. Didn't really discover much that was worth talking about. They disclosed it, but we had a retaining wall, which if anybody's retaining walls can be things, retaining wall is like a brick wall that holds dirt back, but dirt and earth and water eventually will win, right? Over a brick wall. And so retaining walls need to be maintained and eventually need to be replaced. And so this retaining wall was starting to buckle. And it was one of those things where like, okay, this is going to fail eventually. And so that was probably the one item, Whitney, that became a conversation, but we were aware of it. And so we put money aside in our capital improvements budget to deal with that. And it turns out that about what we set aside is about what we were going to need. But that was like, not necessarily a curveball, but the one thing that came up during due diligence, it was like, okay, we need a professional engineer to come out and look at this. Roofs were all new, windows were newish. Really, the conversation there was, can we invest what we need to invest in dollars per unit to create the rental increase that we need?
That's not much of a problem or obstacle party. What about the other half of the portfolio?
Well, that's where the surprise party was. I want to say one more thing before we get to the surprise party. You asked, did we walk all the units? And it's important to do some. And for me, my job everybody's got a job at DeRosa Group, right? So my job at DeRosa Group is I have to go out and look at the units, get my head around things and make sure I'm comfortable with it as one of the sponsors on the project. But mostly I go out and create the marketing campaign. And so I go out and look and say, okay, what can I create here that creates an intriguing story for our investors? What is the story I can tell? What does this property want to become that investors want to hear about? And so I go and I shoot a lot of video content. I got my video guy out there flying drones around the property, and we create a lot of the marketing story for the property for equity investors and for our branding and that kind of stuff. So that's what I do. But I also get into a few units. My asset manager, Justin Fraser, who runs operations for DeRosa Group, he goes out and he walks just about everything, as does his construction team, as does the property management team and whatnot. So when you do due diligence, you walk the properties, you walk the units as well. But another thing you do is you audit the financials for the property, because the broker gives you like, hey, here's the profit loss and whatnot, but then they give you the actual statements to back these things up. And so they had given us 18 months, which we always ask for, worth of water bills. So one of the three in Kentucky, they turned over the water bills on. This is surprise number one, right? They turn over the water bills on this property. And it turns out that the water consumption that they'd stated in the broker's offering was an average of water consumption. It was like, hey, well, it was like a bell curve, right? But they didn't take into consideration that the water consumption at the property had been going up and up over the last like 4 months worth of ownership going up to the time of sale. In essence, it had tripled over like the last 3 to 4 months. So we looked at that and we're like, did you guys add 3 times the residents that are taking 3 times the showers and flushing the toilet 3 times as much? And like, no, the resident occupancy stayed the same. Well, something's got to be happening that your water consumption's gone up drastically like that. And the broker was like, well, do your own homework. And so we did. So we brought in a leak detection. And it turns out that the property had significant water leaks in multiple locations, both underground and behind walls. And so we called this out. And we said, hey, guys, you're showing us a median water consumption, but that's not really fair. The way to look at it really is that the way that water consumption should be is what it was. And now you're drastically increasing. So these water leaks need to be addressed. And so they admitted to it. They said, yeah, I guess you're right. And it's funny when you call things like this out, people all of a sudden have amnesia. And it's like, oh, yeah, I guess we forgot or whatever. I think that they maybe were hoping we weren't going to see it or whatever it was, but we caught it. And the purchase price on just this one property that was under consideration was $21 million. We got the seller by kind of calling this out, to reduce the sell price by $1 million. So they dropped the sell price by $1 million because that is how this additional water usage would have affected the bottom line of the property. So you have to translate all these things. It's not just the cost of repairing the leaks. It is the cost of the financial impact that water leak has on the bottom line of the property. And so we got an adjustment on sell price based on this water leak, and we were able to fix it ourselves. But the property's performance was a bit propped up based on what their numbers they said that it was.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFIN Con happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFIN Podcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
So how much capital did you guys have set aside for your renovations across the entire portfolio? But I'm specifically interested about this one with the surprise party water leaks.
With across the portfolio, we had 10,000 units. But so for 670 units, about $6.6 million worth of all-in construction dollars. And that included exterior capital improvements, interior capital improvements across the board. But the addressing of that water issue, we were able to address the water problem itself through about $50,000 worth of repairs.
Okay, so for $50,000 of repairs, you were able to get the value of the building, right, decreased by $1 million. You were able to get that return.
Yeah. And the reason for that is that this water leak was artificially driving up the expense load on the property and was propping up NOI. And had we left the water consumption where it was, the water consumption annualized would have been much more on the property because it was going up and up and up.
Was this a landlord incurred expense or was this a tenant incurred expense? Were they
landlord? Unfortunately, not in Kentucky, but just at this one property. It does happen in Kentucky, but it's really the landlord's choice. But you see a lot of landlord paid utilities in Kentucky. And a lot of times it's landlord paid everything, like electric, gas, water, all of it. Everything but the cable bill, the landlord's paying. And so it doesn't happen all the time, but that is something that does happen sometimes. This property was all landlord paid utilities.
I want to get to the financing piece because this is right before the debt run up, the interest rate.
Yeah, man.
But were there any other surprises here that had you scratching your head whether this deal was going to go through or not?
You tend to always have that on properties. You tend to have, for older vintage properties, these are older, we tend to end up, because we buy workforce housing, Whitney, so we tend to buy stuff that's more in the 70s, 1980s, because we cater towards the median of society, like those that are earning at or around the median income of an area. That's our tenant, not the high end, not the super low side, just middle of the road, blue collar America. So if you're doing those kinds of properties, then you're going to end up with properties that sometimes are a little dated. And so there are things like galvanized pipe. There are things like aluminum wiring. There are things that are just a little dated and older from like the 70s or 80s that they used to do back then that we don't do anymore and that you tend to come up with. So we know how to budget for those kind of things when we assemble construction budgets for property. So a lot of modernization or addressing of older vintage issues that you tend to see was in that construction budget too.
And do you ever have any issues securing insurance because you're taking on those obstacles, those challenges?
No, Well, let's use aluminum wiring for an example, right? Aluminum wiring, it can be a fire hazard if it's not properly dealt with. And typically in the walls of my home and your home, it's copper wiring. But back in the day, I guess they thought aluminum could be cheaper. Maybe those were run on copper back in the 70s or something. I don't know. But for one reason or another, for a couple of years, they did a lot of wiring using aluminum. And that can be a fire hazard if it's not terminated properly in the actual outlet box and at the electric breaker. So what the insurance company will require you to do is to terminate the wiring properly at the outlet and at the breaker. There's also things that are just no-nos, like stab lock breakers, Federal Pacific breakers, those kinds of things. They can be older vintage things that they thought was a good idea to do in the 70s, but end up being fire hazards. So the insurance company will either require that the seller change those things before closing, or they will require that within, like, let's say 90 days, us as the buyer deal with those things and do them out of pocket. Kind of don't care either way, just as long as they're not even going to say, we're going to charge you more insurance. They're just going to say, we won't insure your property unless you sign off on this piece of paper right here that says that you're going to do that work, and we're going to come back and inspect on day 90 to make sure that you did. And if you don't, we're going to drop you. So that's kind of how it goes. So they'll insure you, but you have to agree to do remediation.
Awesome. Okay. What kind of loan did you put on the property? Did you have any lockup periods, prepayment penalties, or anything like that?
We did. Again, this is workforce housing value add company. We buy stuff that's not at the level that it should be at for the area that it's around. We inject a lot of capital into it and bring it to the next level. And so what makes sense, and this has kind of become passe and like, oh no, you used one of those. We used a bridge loan, right? And now it's been like, oh my goodness, a bridge loan. We did. What a bridge loan is, and it's still a great vehicle. It's just something that's changed a lot in a changing economy, right? A bridge loan just simply means that it's a bridge. Like you and I'd walk over a bridge to get from one place to another. A bridge loan is designed to get you from where you are to stabilization. And at that point, you could refinance it over to an agency loan. So we put bridge loans on these property, which back in the day, and I say back in the day, like a year ago.
It was a year ago.
Yeah, I know, right? We were borrowing money at like 3.5%, somewhere in there, 4% on the bridge debt, with like a lot of the construction money contributed to the project. So it's all good. The rate did float, which is fine. And it's just total blessing that they required us to do this. They required us to buy a rate cap, which means that it's like an insurance policy that says, yeah, I understand rates are at 3%, but if they go above 5 or whatever the number is, the insurance policy will start paying the interest above that cap for you. And so we didn't anticipate rates to skyrocket as quickly as they did. People like to pretend they're brilliant in hindsight. Well, I knew no, you didn't. Not many people knew that rates were going to do what they did over the last year, right? So, hey, that's not something. We did have rate increase in our underwriting, but to be conservative, we put those rate caps in place. And so lucky we did, because as rates went nuts, our rate cap got struck. And so we hit the rate cap. And that means that the bank is now getting part of their payment from us and part of their payment from the insurance policy.
And so it sounds like your plan is to get this project to stabilization. And Are you looking to refinance out, sell? Like, what are you looking to do during this term of the loan? Yeah,
well, the bridge debt typically gives you 2 years. And then you can option into another year if you need it, which we're not going to. We're like halfway done our value add program now. This has been a year. So it's our current desire to refinance, although we have like 1,200 units in Kentucky now, Whitney. So there is conversations among our team like, well, maybe we'll package everything up because the next level buyer could be very interested. These are buyers that like have management companies under their ownership that are rolling in with a lot to put to work. And if you think about it, 1,200 units that we own out there, we employ about 40 people that help run those properties that we have, which is great. I love that we're employing a lot of people, but a new buyer could also inject their team and kind of have a property management company and assets to feed that property management company, everything in a box. So maybe we do it that way. Maybe we refinance and hold the assets. We still love Lexington. So we haven't decided yet, Whitney, honestly. And I think that I'm not one that goes into a business plan knowing exactly what the exit's going to look like, because I can't predict what the market's going to be in 5 years, 3 years, 2 years, whatever it may be. When we are finished our reno and we feel like we're stabilized, that is the point where I kind of look at the market and say, okay, what's the best way that I can return investor value? I can give investors the best value they can by refinancing and holding, if I think that's a great stable place to be for us for the next 5 years or whatever for investors. And that's what we'll do. But I take action based on the best thing I can do for my investors in that moment. And so if that means that we've certainly sold when it was the right time to do that, if it means that we refinance and hold, then we'll probably do that too. But I couldn't tell you what we're going to do because we're not there yet. I'm not at that fork in the road. But when we get to that point, then we'll make the decision. We bought really well. We got great prices, even with where the market was a year ago. And luckily enough, yes, we're on bridge debt, but luckily we bought really good, affordable rate caps on these properties from a year ago and stopped the rates from going up any more than they already have. So we're very stable, doing well, and we've got a lot more runway ahead of us to increase the value of these properties. So we'll see when we get there, right?
All right. So remind me again the purchase price and then how much debt you put on the property. And then you also raised to close this, right? You've been talking about your investors. Walk me through the structure of like that capital stack and how you structure the deal for your investors.
Yeah, sure. We bought it for $57.5 million, I believe. And we borrowed in the neighborhood of, say, $39 million, I believe, on the portfolio. So the total equity raise was around $21 million, and including the capital that we needed to get started. It's good to go in with a lot of cash for getting started on these properties. It's good to have money for closing costs and that kind of thing, and construction reserve. So just because when you're on a bridge loan, you have to advance, do the work, and then the bank pays you back. And then you do the work, and then the bank pays you back. And that's kind of how you spend the money that they're committing to give you on your bridge loan, right? So that's in essence how we structured the debt. Now, on the equity side, I'm blessed enough, Whitney, that I've got a lot of folks that believe in DeRosa and my company, and we were able to get a lot of our attention because of my book, Raising Private Capital, and because of our continued work in multifamily. And we've gotten pretty good, as you guys have, about broadcasting ourselves and waving our hand in the air, but like, hey, look at us. And so we drew a lot of that those investor eyeballs to the deal because of our track record and because of who we are. We did it through 506C, which means that you can solicit accredited only. I'd rather do 506B deals because I believe that what we do as syndicators, what both our companies, PassiveInvesting.com and DeRosa Group offer, should be available to everyone. It really should. Wall Street should not be the only way people build their wealth. So I believe in 506B so that you can go to non-accrediteds, but you also can't solicit and market. So we went 506C because of this enormous equity raise that we had, which enabled me to do YouTube campaigns and Instagram campaigns and Google pay-per-click campaigns and that. And we just told the story about the deal, about the workforce housing aspect of it, about the economic and geographic diversity, and we were able to raise it. I mean, it was a slug, but we got through it.
Awesome. Okay. So, and how did you structure this? Like, did you do a preferred return?
Yes.
What kind of splits did you structure for your investors?
We do two classes of shares, Class A and Class B. So we do Class A shares that are fixed rate of return, like no upside, almost like you loan money to us. So you get like a fixed rate of return. We pay out monthly. Here's a monthly check. And as soon as we refinance the property, we return those shares, retire those shares, buy that equity back from those investors, and those investors are gone. That's Class A shares. It's a short-term option for people. And those listening should consider providing a short-term option and a long-term option. I used to do a lot of deals with those that would invest in fix and flips with me or in BRRRR strategy deals. And some investors enjoy putting their money to work for a little while. Not everyone wants to be in a deal for 5 years, 10 years, however long it takes the apartment building syndicator to return value. So we wanted to have something that was able to give investors a return on their money and then their money back in like a year to 2 years, right? So that's what the Class A shares are all about. And then many Class B shares where they make a preferred return also, and they also get a 70% of the upside. So for every dollar the property makes, they get 70 cents on that dollar above their preferred return. Those are the Class B shares. They're in the long haul. As we refinance, they may get some of their money back, but they still retain their ownership long term. They are our partners until the property sells.
Another part of structuring this deal are the fees.
Yes.
How did you structure the fees in this deal?
So we take a 2% acquisition fee. That's so 2% of the purchase price came as a fee back to us for all the harder work that we put into the deal. And a lot of times
surprise party that you had to throw, right?
Yeah, for dealing with surprise party, for dealing with everything that it took to get the deal to closing, including sponsoring the deal as debt sponsors and everything, like all the stuff we had to do. That's where that went. A lot of times that's like the only money we make for a couple of years. That's significant because we don't get really share in profit on the deal for a couple of years until the deal is able to stabilize and get rents up and get the property performing and dissolve all those deferred maintenance issues and yada, yada, right? So that's that. And then we also take an asset management fee. It's 2% of rents collected. And that typically goes, it's not really a profit line. Investors should view that to be just a compensation for a little bit of compensation for a lot of time that we spend with the property management team, implementing the vision and pushing the property manager along and everything like that. So that's 2% of collected rents each month. And then aside from that, we take a chunk of the profit on the back sale of the property. So when it sells, or maybe when we're lucky enough for it to be performing above the pref, if the investors are getting 70 cents, we get 30 cents.
Well, Matt, usually I ask a wrap-up question here, which is one thing that you thought was going to be easy and that actually turned out to be hard. And I'm going to say that's probably your surprise party that you had, that you stumbled on here.
Yeah, I thought that, to be honest, this was back a year ago when there was a lot of just money getting slung around towards real estate. And a lot of people were doing this thing called money hard, meaning like the first day you put the property under contract, you got money non-refundable. And so I was a little concerned with all this surprise party going on at that one property, especially with the water leaks and the other issues that I didn't even get to. There was a lot of party happening. That seller was surprisingly easy to work with and willing to give us like, yeah, you know what, you're right. I was wrong on the water issue. Here's a credit for $1 million, 5% of the purchase price of the property. They gave us off because they admitted that, yeah, you're right. We made a mistake. Here's your credit for this. So I was really grateful. And I thought they were going to like, oh, no, you're under contract and we're going to have to deal with it. Honestly, that's what I told myself is that we may have to buy this property no matter what. We might have to walk and litigate, right? But which we didn't. They're very amicable. So the sellers, I think, were more amicable because I've dealt with non-amicable sellers before. And so these sellers were very easy to work with, probably some of the best that we've ever worked with in transactions. So I'm grateful for that. The equity raise was hard sometimes because you're not sure where all that's going to come from, but it was easy other times too. It turns out that we ended up refining one of our properties, that we have another property out in Kentucky. We refinanced it during this purchase price cycle. We're like, okay, hopefully some of those investors are going to recycle some of their cash back into this deal. We weren't sure if they were going to or not. They did. That was exciting. And then we also had another sale happen. So some of those investors that were in on that sale were able to move their capital over and defer their gains from that sale over to these properties because we had a cost segregation study here that could help them wash out some of those gains. So wasn't sure where all the equity was going to come from, but I think in walking forward in faith, the chips kind of fell where we needed them to by just kind of acting as if that makes sense. Good surprises and surprise party surprises, right?
Right. Yeah. Well, Matt, thank you so much for sharing your time, knowledge, and expertise with us here today. If listeners want to find out more about you and what you're doing, how can they contact you? How can they reach out to you?
They can go to my website, derosagroup.com, 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 where they can hear more about what we offer and what we're all about as a company. They can also, if they want to check out some of the education vehicles that we have those as well, they can learn about that and they can pick up a copy of my book at derosagroup.com too.
Awesome. Well, Matt, again, thank you for your time and sharing it with us here today. We look forward to hearing more from you here in the future.
I look forward to being back to talk about another deal with you. Thank you, Whitney, for having me.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.